Hello and a warm welcome to this quarterly update from SKAGEN Global. Portfolio manager Søren Milo Christensen has joined me and will walk us through what happened in the second quarter of 2014. Søren, how would you describe the fund's performance so far this year?
Yeah, no, I think we've been very pleased with the results so far this year, and particularly in the second quarter. Obviously, what we really care about is the absolute return. Obviously, very pleased to see that the fund is up close to 7% so far this year, and basically all of that return came in the second quarter, so that was very good. In terms of the relative performance, it's not something we care too much about in the short term at least, but of course, again here pleased to see that we did better than the market in the second quarter, and year to date it's basically in line.
Very well. What developments have you seen in the markets recently?
Yeah, I think the big story, as you see in this slide, in terms of the second quarter, was really that the trend that you saw throughout 2013, and actually also in the first quarter of this year, really reversed in the second quarter. And basically what I'm talking about is the weakness in emerging markets. So you really saw a lot of the emerging market indexes coming back strongly in the second quarter. As you see on the slide here, you have a number of particularly some of the markets doomed to be sort of the fragile five, really doing extremely well in the second quarter. And of course, as we said last year, given we have a relative high exposure to emerging market, that clearly hurt us in last year. It really hurt us in the first quarter, and was clearly a sort of a helping factor in this quarter.
Mm-hmm. And few of the markets have had elections since last time. What impact has that had?
Yeah, no, particularly for a country like India, as it had a massive impact. You saw a new president coming in. He has a very strong track record for doing some of the structural reforms that India clearly needs. So far, it seems like he's really sort of hit the ground running, and the market has taken that extremely positively.
Okay, so India and Turkey has been...
Yeah, no, I think more Indonesia probably, but that was here in the beginning of the second quarter. You had election there. Again, here the right candidate won. So it seems like we still don't have the final results, and I think have to be a bit careful in Indonesia in terms of the pollings coming out. So we'll see, but it seems like the right candidate is going to win, and again here that would be very positive. Indonesia, like India, could really need structural reforms. They need to cut energy subsidies, and they need to spend much more on infrastructure.
Okay, let's take a closer look at the companies that have provided the good return.
Yeah. No, as you see on this slide, if you focus on first the left side, the biggest contributor to absolute return was Samsung Electronics. And I actually think that was sort of a very interesting quarter for Samsung. For those people that follow the financial press, they probably noticed that earnings expectations for Samsung actually came down quite a bit during the quarter. The reason being that profitability in the handset business is declining. And it's really sort of something that we've tried to say for a long time, that current profitability in the handset business in Samsung is clearly not sustainable. It is going to come down over the long run. The thing is, if you look at where the market is pricing Samsung, they're basically saying that profitability in handset is going to go to zero, and it's going to go to zero very fast. And we think that's wrong. And I think Samsung has so far clearly proven the market wrong. They've kept profitability at a very high level for a long time. And we think they're going to prove the market wrong, that yes, margins are going to come down, but they will stay well above zero. So I think that's the first interesting development. The second thing is that I think the market has become accustomed to the fact that Samsung spends all their free cash flow in capex. And that's been right if you look over the past few years. Basically, as Samsung has had a lot of growth opportunities, so it's been the right thing to do. But now they're in a situation where they don't spend all their free cash flow on capex. And again here, looking at the valuation, the market is saying that you will never see that cash flow, they will never pay it out. And again here we have a different view of Samsung. I think if you have followed Samsung for more than the last 3-4 years, you would notice that actually in periods where they have had excess cash, they've actually been fairly good at paying that out. And what we saw last quarter was that sort of the big shareholder in Samsung he's very sick, and that has led to speculation that given inheritance taxes are very high in Korea, that if he were to die, his children were to inherit the shares, they are facing a very substantial tax bill. And the only way they can really pay that tax is by getting more cash. And so obviously the most obvious way to do that would be for Samsung to pay out more in dividends. And that clearly has helped the shares this quarter. Otherwise worth mentioning Weatherford, an oil service company. This used to be a oil service company with poor profitability and with way too much debt. Our thesis has been that they can fix profitability and they can very easily fix the financial debt situation simply by starting to sell non-core assets. And that's really what we've seen. So they've taken small steps in terms of improving profitability, but they've actually taken some fairly substantial steps in terms of reducing financial leverage. And that has really sort of depressed the risk premiums coming from very high levels, and that has helped the shares.
And on the flip side of that coin?
Yeah, I think we haven't had any sort of major blow-ups, if you like, in the quarter. But clearly, if you look at the top two losers here, Stolt-Nielsen and AkzoNobel, both of them came with somewhat weak first quarter numbers. So for Stolt-Nielsen, it was mainly the tanker business that disappointed in the first quarter. We think a lot of that has to do with the macro weakness you saw in the US for the first quarter, basically as the weather was really bad. So it's not something we think is sort of sustainable. For AkzoNobel, clearly paint demand in Europe was weaker than expected. But again here, our thesis for Akzo is not so much about demand in Europe. That would be a nice upside, but really the thesis is about them restructuring their business, improving profitability, and that has little to do with whether sort of demand in Europe is a bit weaker or a bit better than expected.
Okay, let's see what changes you've done in the portfolio the last quarter.
Yeah, if we start on the left side here with things we've added to for Lenovo and for Gap, we have separate slides on that later, so we can talk about that then. For AIG, a global insurance company, it was already a big position in the fund. We made it even bigger. The reason being that we really see our investment thesis playing out, and the market isn't giving the company credit for it. So basically, we are thinking that they do all the right things in terms of restructuring their business. So all the things that they've talked about, they're clearly doing it now. You haven't seen it show up in earnings so far, and that's why the share price hasn't reacted yet. And that's basically what we think gives an interesting opportunity to add to that position. The other one, Philips, came with somewhat weak first quarter numbers. The share price came down quite a bit on the back of that. We think most of the factors that you are seeing contributing to the weakness, particularly on the healthcare side, is something that is cyclical in nature, not structural. So again here, not something that really changes the long-term outlook for the company, and for that reason we added to that stock.
And you also sold some shares in other companies, yeah?
We did. We sold or reduced quite a few shares. For most of these names, it's basically been a consequence of share price coming up. For that reason, we see less upside, and so we reduced our positions. For the stocks that we sold out completely, if we start with ADT, US retail or consumer security company, I think that the thesis has changed a bit there. So this was about a company that produced very strong free cash flow, and they were very disciplined in using that free cash flow to buy back shares. So what we've seen is that the competitive environment has become tougher. That means that churn rates have been going up. And the reason that's a big problem for ADT is that acquiring new clients is very expensive. So the way the model works is that ADT, they pay for the installation of the security system. They typically sell through external agencies. Of course, they need a commission. And so for that reason, if your churns go up, you basically need to acquire new clients simply just to stand still. And as that is very expensive, that sort of destroys the free cash flow story in that company. So that's why we sold it out. For Tesco, a bit of the same here. I think the relentless pressure we're seeing from the sort of the hard discounters seems to be putting so much pressure on Tesco that they will be I don't think they'll be able to turn around the business in the medium term, and for that reason we've sold our shares.
Mm-hmm. Okay, very well. And the largest holdings in the fund?
Yeah. I don't think there's too many surprises here. Most of these stocks have been in here for a long time. So again, here what we really focus on is the valuation. If you look at the top 35 positions, I mean, trading at a PE 2016 of less than 9 times, clearly very attractively priced for companies that are growing, companies that are paying out dividends. One thing worth highlighting perhaps is that Tyco International isn't here anymore. It's been there for a long time. Has had a very strong contribution to returns. The company is still doing fantastically well. So the only reason we sold it out, or sold it out of the top 10 at least, is that as valuation has come up, I think most of the good things we expect from the company has basically already been priced in. Okay,
very well. Any other companies you would like to mention?
Taking a slice here on sort of the newcomers. The first one is Lenovo. It's a Chinese IT company. I think most people probably know the ThinkPad brand, which they acquired from IBM back in 2005. But I think what's really interesting here is what they've done with that brand. They've really been able to grow the old IBM PC business. I think particularly in the last few years, where we've seen PC demand really taking a hit. They've been able to grow in a declining market. They've been able to expand margins, so very impressive.
It's actually, I think, the world's largest manufacturer of PCs, of personal computers.
Yeah. So they've done tremendously well there. Another area where they've done well is on the mobile handset business. So they are now actually the world's 4th largest handset manufacturer. Particularly in China, they're extremely large, but they're also doing well in a number of other emerging market countries. And so what they've done sort of lately is that they acquired the handset business, Motorola handset business from Google, and they acquired the service business from IBM. Both of these businesses are loss-making. And so the investment thesis for us is really, if you look at on the left side of this chart here, you see that valuation PE 2016 trading at 13 times earnings. So basically, the market is telling us that there's not going to be any growth after 2016. And we clearly think that's wrong. Firstly, there's plenty of scope to grow top line. But I think more importantly, you will see substantial earnings growth coming from improved margins. So as I said, we're really betting on them being able to turn around the Motorola business, turning around the server business they acquired from IBM, and also continue to expand their margins in their own handset business. Because even though they are the world's 4th largest manufacturer, I mean, they are making margins just slightly above zero, and they should be able to grow that quite a bit. So we think the market's going to be surprised in terms of how much earnings will grow in the next 5 years. And sort of a large part of that will simply just come from them improving their margins.
Mm-hmm. All right, the next company you brought with you is one we all probably know.
Yeah, so Gap, of course, an apparel retailer. Very big in the US, but also has exposure outside of the US. Obviously, the sort of most known brand they have is Gap, but they also have the brand Banana Republic and Old Navy. And again here, the story behind Gap is really that they ran into some serious problems sort of in the beginning to mid-2000s. Had a new CEO coming in 2007. He's done a tremendous job turning around the business. So it's now sort of on par with peers. But again here, the thesis, if you look at the valuation on the left side here, PE 2016, 12 times. Again here, the market is saying this is a company that has no growth after 2016. And we think that's wrong. But the company has focused sort of all the energy on in the last 5 years is fixing profitability. And so they are now in a position where they are now again ready to start growing. So they can clearly grow their retail presence in the US, have huge scope to grow their retail presence outside of the US. They have big opportunities to grow their online business. And unlike most other online businesses, they're actually making a profit. So we think that there's quite a few growth opportunities for them still to come. And we still don't think that they are completely done in fixing profitability. We still think that margins will come up, mainly from some of the supply chain initiative that they're taking. So again here, we think the market is wrong. This company is going to grow quite substantially over the next 5 years.
Is this the first large clothing manufacturer that you've got in the portfolio? I can't remember having seen any.
No, it's at least sort of in sort of the last few years. It's one of the few that we've had in this area. There's no doubt that this is it's a difficult space, right? It's particularly sort of staying on top is very difficult. So prefer to pick companies that sort of where we've seen evidence that they are moving in the right direction, but where there's more to come.
Great. We're looking forward to that and to seeing all the portfolio managers in Gap clothing, right? All right, thank you very much, Søren.
Thank you.
We have a brand new market report out, so please keep your eyes open. It's on our web, obviously, and we have to wish you all, or we want to wish you all, a nice summer, and thank you very much for watching.